Hey traders, Raghi here. I'm sitting here in the office and I've gotten a lot of emails of folks asking me, Rag, what is going on with the weakness in the market and why do we suddenly care about this yen carry? And that takes us to the first question there in the notes, as you can see, which is what is a carry trade? What is the carry? And the carry is an interest rate conversation. So if you take a look at the screen here, at the very lower corner, right here, you'll see the central bank rates. And what these show is what each central bank has as their rate. And the yen, you can see, is just under 0.25%. Not all that long ago, in March, this was actually a negative rate. And then it went to about 1/10, right? 0.10 in March. And then recently, on July 31, they raised the rate to about just under 0.25. Now, this is the first rate hike from the Bank of Japan in 17 years. All right, so the first one occurred on the 19th of March, and the second one took place on July 31st. So the question is, the yen has been hiked, so why do we care so much right now? So here's that March 19, and there was literally no reaction in the US dollar versus Japanese yen. I'm using a futures contract here. You could use the dollar yen spot Forex, which would be probably a little bit better, but I wanted to pull it up in the futures just to show everybody what this is. Now, if you do pull it up in dollar yen, which is cool, what you're looking at over here on the side is the way in which the US dollar is weakening against the Japanese yen. Right? If you look at the 6J, for those of you that are futures traders, this is the way the US dollar is weakening against the Japanese yen. So while it looks inverse, it's just the order in which the currency is quoted. In the Forex, the US dollar is the base currency, the yen is the second currency, and in the Japanese yen, the yen is the first currency. So it's just the difference between whether you're swapping yen for dollars or dollars for yen. Of course, the quote would be different. So we have two hikes. And the carry is the interest rate differential between the yen and whatever other currency you want to look at. So if it's yen versus New Zealand dollar, you'll see it's about 5.25. If it's yen versus US dollar, it's about 5.25, etc. Right? Now, the idea of a carry is if I sell or borrow the yen and then go buy what I would anticipate to be a higher yielding asset like stocks or another currency with a higher central bank rate, I make the difference. It's a percentage difference. And at scale, and I'm talking millions of dollars, at scale, think about making 5%, 4% for just being in a short yen position. It could be a short yen position against the New Zealand dollar, the US dollar, the British pound, etc. Any currency with a higher central bank rate. But all of a sudden, on the July 31 decision to hike again, where now we went from negative to slightly positive in March, and then slightly positive to just under 0.25%, 0.25 on July 31, it was essentially a bridge too far. That kicked over. So think about it. If you're taking advantage of the interest rate differential, and that difference of about negative to 0.25 point erodes your edge, all of a sudden you have a problem. Now, we'll never know totally what the foreign exchange, the spot Forex market is, because it's a non-centralized exchange, which is why it's kind of easier to look at the yen, because we can look at the commitment of traders report from the CFTC, because you got to report those futures holdings. But roughly it seems to be about 14 billion in a yen carry. But again, we can't really know for sure. Approximately half of that has been unwound already, says the CFTC, again, based on that reporting that happens at commitment of traders at the end of every week. All right, so that's the carry. So what happens to a currency when a central bank hikes rates? It actually increases in value. So any country with hawkish monetary policy or policy that favors higher rates, it also then favors a stronger currency. And that's what the Bank of Japan wanted. They were tired of the yen so weak and they wanted to give it better buying power. That's it. Because remember, when they're buying goods with a weakened yen and that 17-year flat or even negative rate weakened the yen, they wanted to increase the yen's value, which they did. Now, here's the challenge. At the same time, the U.S. central bank is looking to cut rates, which weakens the currency. Now, you'll notice what I pulled up here is the 6E. This is the euro futures. This is the euro versus U.S. dollar, and it's the best way to look at the U.S. dollar because 50%, actually more than 50% of the U.S. dollar basket is against the euro. So if you want a really undiluted, direct view of dollar weakness, U.S. dollar weakness or strength, you look at it via the euro. And when the euro moves higher, that is the U.S. dollar moving lower. So the U.S. dollar is moving lower against a lot of things because the central bank is getting ready to cut. And that is a weakening effect to the underlying currency. So this was only exacerbating the Bank of Japan hiking rates, strengthening the yen as the FOMC is looking to cut rates, which would then naturally weaken the dollar. So all of this was going to come to a head at some point. What we did not know, and by the way, 2 and 3% swings, folks did not know where the threshold was, right? So please don't think this is something we saw coming because when the first rate hikes were done in March, nothing happened. It was when the most recent rate hikes happened that everything started to really kick into high gear because clearly that quarter point started to erode the edge that traders, that these asset managers, these large funds had. It started to erode their edge of profit. It became a real problem with that quarter point higher rate. All right, so now fast forward to where we are. On the 2nd of August, if you go back to just Friday, on Friday, we had the non-farm payroll. Now you can see that we had launched a little bit higher, but we paused a bit. And then on the 2nd, when we got non-farm payroll, this was a very disappointing number in the U.S. And it exaggerated the U.S. dollar weakness because all of a sudden, now this is where the U.S. dollar starts contributing to the yen-U.S. dollar relationship. With a very weak non-farm payroll, average hourly earnings were less. The unemployment rate ticked up. The non-farm's headline number was a miss. It was lower than expected. September 18 meetings went pretty much straight to being fully discounted for a half-point cut. Now remember, cuts are bearish to the currency of the country while hikes are bullish to the currency of the country. So at some point, think of it like the Olympics and a relay race. The yen kind of handed the baton off to the U.S. dollar. So what yen strength we saw on the 31st, now the other way to keep the yen-U.S. dollar or just the yen strong is to have the other side of the currency weaken. And that's exactly what we saw with the non-farm payroll. The U.S. dollar weakened as expectations for not just a quarter point cut, but a potential half point cut got discounted. And that's going to weaken the U.S. dollar, and it's going to make the yen strength even more exaggerated against the U.S. dollar. So that's what happened to the U.S. dollar Japanese yen. It wasn't just that second hike the Bank of Japan gave the boost to the yen. Then it turned into dollar weakness exaggerated with that fairly awful non-farm payroll. So the timing is the 31st hike from the Bank of Japan coupled with the dollar weakness with the non-farm payroll, where target rate probabilities really started to crank into, hey, Jerome, you could have cut in July at the 31st meeting, but instead you waited, and then now we want a half-point cut, cue the dollar weakness, all right? So again, we talked about when the Bank of Japan hiked rates, and it wasn't just the rate hikes that were the problem. Remember, we've had higher rates since, March 19, and then the second hike, which took us to just under 0.25%, happened on July 31. So this matters because now it's more expensive to borrow yen. Part of the carry is to use this very inexpensive currency to buy higher yielding assets. like stocks. So we know what triggered the weakness. It was two different events, right? And then another thing that's kind of outside the macro and the currency analysis is, did brokerage outages on Monday contribute to some of the panic in the US? It has to, right? When Schwab, Vanguard, and Fidelity, I don't know, they seem like kind of small brokerages, right? When these three create problems, traders are in panic because they can't log into their accounts. That also contributes to selling. Now, that's the backdrop of all of this. The next part is, all right, well, Rog, what's going on under the hood? What are you in? How are you trading right now? Because we've talked about this for about 10 minutes now. So let's get tactical. All right, let's get tactical. What happened today? We take a look at the normalized performance. You'll see here on the right, industrials actually were pretty strong. Now, nothing was positive, mind you, right? Nothing was positive. Your zero line is way up here. Nothing was positive. But in terms of the least amount of weakness, industrials, staples, energy, you can see we have a number of different sectors that were able to withstand, to a certain degree, some of the sell-off, and others got hit very, very hard. All right, this is a little bit easier to see here. So take a look at the order in which, there we go, that's a lot easier to see. Take a look at the order in which everything was weak. All right. Now that's a one-day relative performance. What about month to date? I know we're only a handful of days into August, but this is not a surprise because staples and utilities have been very strong. They've been very strong, as has healthcare. So while everything was down, if you're wondering, Rog, what kind of positions make sense to have on? So I'll talk my book because at this point, that's all that really matters. We're long Coke, and we continue to be long Coke. This is a position from last week. We continue to be long utilities via XLU calls. So we have KO calls, XLU calls. I just built a position in Johnson & Johnson. So we're long the parts of the market, right, that are more stable than others. Am I in things like regional banks or consumer discretionary or financials? No, not. And by the way, if you're wondering about this XLC here, that's a sneaky little sector. XLC, which is dominated by Meta and the Googles, are not strong. What's strong within XLC is the telecommunications part of it, the IYZ, which are things like telephone, T-Mobile, Verizon, Charter. That's actually performing very well, and I'd keep an eye on telephone. If you take a look at the last 1 month, all right, you can see there's been an abrupt shift. So certainly this shift has been damaging mostly to the number one sector of the last month and really the quarter, which is KRE. KRE has been hit the hardest because it's syncing with the Russell. But ultimately what we have is still a lot of resilience in the defensive corner of the markets, staples and utilities, and healthcare continues to, at least the previous 5-day flows, continue to be pretty positive. So I'd keep an eye on names like Johnson & Johnson and Pfizer and UNH, all right? So that's where we can still look for opportunity. Now, if that's for a swing trading time horizon, the trades that I have on in the mastery are at 2 to 10 days, maybe to expiration, which we have a lot of August 16 expiring options. But what about if your time horizon is longer, right? And this is where it gets exciting. If your time horizon is longer, maybe it's months, right? Let me show you what we've been doing the last 2 months, right? The last 2 months, we've gotten long things like McDonald's from 250, 330. We've got long things like Mondelez from far lower. So what I want to mention is that not everything is getting hit really hard, right? Things like Pepsi, PEP. So there's a number of longer term positions that we've already bought from pullbacks and that are all up, right? They're all still up despite the meltdown, but the time horizon is at least 6 months. So if you watch the video that I recorded on Friday, Markets Not in Turmoil, I don't like the word markets, and neither should you. The reason for that is markets typically mean the S&P, right? We just kind of broadly paint the entire behavior of currencies, treasuries, metals, energies, the indices, and the sectors with, well, the S&P is down. So we don't want to paint that one stroke brush of the S&P. We want to break things down. So we don't want to talk about the markets. There's no such thing really. Individual sectors, individual symbols. And so when we break down what's performing well, we can find a lot of strong names. Pfizer was up today. Newmont Mining was up today. So there are names that are benefiting in this current environment, just not as many as they used to, and clearly not the names we all know and love, right? It's not semiconductors, and it's not Apple, and it's not Microsoft. Not yet. With the VIX as high as it is, just sort of the wisdom of a VIX spike to this degree is usually if you have a 6 to 12 month time horizon, this is a buying opportunity. Not to pick the bottom, but if you're willing to start going into certain positions now, 12 months out, 6 to 12, I have found you're really starting to build positions with that longer time frame. So shares, leaps are going to be great places to look. And that's what I mean about being opportunistic no matter what. I don't ever look at anything in turmoil. Wall Street's the one place they throw a sale and nobody comes. All right. So I hope that gives you something tactical with what's happening right now. I'm not going to say this is just the carry unwind. It's a lot of other things happening at the same time. It's a threshold that was reached when the second cut the first cut took us from slightly negative rates in Japan to slightly positive, about negative 1.0 to about positive 1.0. Now it's taken us to just below positive 0.25. And then remember, non-farm payroll weakened the dollar by boosting expectations for an FOMC cut. And that's how we are where we are.